Good evening, and welcome back to SleepWise. Before we begin, a gentle reminder. If these stories help you unwind, you can follow and subscribe to SleepWise on YouTube, Spotify, and Apple Podcasts. Tonight, we start not at the beginning, but at the moment the air changes. Imagine Tokyo in the first months of 1990. The trains still arrive with their familiar precision. Convenience stores still glow softly on the corners. Vending machines hum like tiny lanterns. From the outside, nothing looks broken. And yet, inside offices and bank branches and living rooms lit by television light, numbers are shifting in a way that feels personal. A market that had been rising for years has begun to fall, not in a single cinematic collapse, but in a series of steady, unsettling days. A slope where yesterday's confidence starts to feel like a story you no longer quite believe. Screens update, newspapers arrive, people read them twice, then fold them carefully as if the paper itself might be fragile. What's strange about a crash is how quiet it can be. There may be no shouting, no running in the streets. Often, there is simply a new kind of silence. The silence of people who are recalculating the world. In the late 1980s, Japan's financial markets had carried a kind of shimmering certainty. Stocks climbed, land prices swelled, buildings and neighborhoods began to feel like they were made of upward motion. It was the kind of era where growth didn't just happen, it was expected, assumed, planned around. A rising market can make the future feel easy to picture, as if the path ahead has already been drawn. And then, in 1990, the drawing begins to smudge. To understand why this mattered so deeply, it helps to remember that markets are not only charts, they are agreements. They are the shared belief that something will still be worth what we think it's worth tomorrow. When that belief weakens, even a little, it changes behavior in quiet ways. A bank becomes more cautious. A company delays a decision. A household waits. And when many people wait at once, an economy can begin to move as if it's walking through water. So tonight, we'll sit gently with that moment. The morning after the peak, the first feeling of gravity returning, and then slowly we'll drift backward to the warm, easy conditions that helped prices rise so high. We'll trace how credit, confidence, and culture wove together. We'll watch how the story of wealth became tangled with land and leverage, and how the unwinding can take far longer than the climb. And when we've understood how it happened, we'll return to where Japan stands today. Older, steadier, still influential, and quietly connected to the rest of the world through interest rates, currencies, and the hidden currents of global finance. For now, though, just let the city settle around you. Let the light soften. Let the numbers blur at the edges. We're only beginning, and there's no rush at all. The days after a peak rarely announce themselves as history. They feel ordinary at first, like weather, a cloudy stretch, a change in wind. But in offices where ties are loosened at late hours And in homes where slippers whisper across tatami, something has shifted from expansion to caution. In those first months, the numbers do not simply fall. They persuade. They persuade lenders to look twice at what they once approved with ease. They persuade investors to stop imagining the next rise and start wondering how low is low. They persuade ordinary people to delay just for a moment the purchase they were planning, the renovation they were considering, the risk they were about to take. And when a whole society delays at once, the effect is gentle but enormous, like a tide turning. In Japan, the turning did not happen in a vacuum. The country was not chaotic. It was, in many ways, impressively ordered. That's part of what makes this story so quietly haunting. How a place can remain functional, safe, and beautifully arranged, and yet become trapped in a kind of economic slow motion. Because when asset prices fall after years of climbing, the damage is not only on paper. It reaches into balance sheets, the ledgers that quietly decide what is possible. A company that once felt rich enough to expand now feels the weight of debts taken on in confident times. A bank that once believed collateral could only grow now watches that collateral shrink and becomes careful, sometimes painfully careful, about lending again. This is one of the simplest truths we'll carry tonight. In an economy, confidence is not a mood. It is a mechanism. And now, as we settle into this early 1990 scene, we can notice how the crash begins to seep into the seasons. Spring arrives, and the cherry trees do what they always do. Summer follows, yet underneath, the financial system begins a long process of adjustment. Not a single clean correction, but a drawn-out recalibration of what things are worth and what risks are acceptable. Years later, people would call it a lost decade and then realize it was more than one decade. But in the beginning, it didn't feel like a decade. It felt like a month, like a year, like a pause that surely could not last. And because we're starting at the fall, we can hold this question softly, like a stone warmed in the hand. How did it get so high in the first place? Not in the dramatic way people sometimes imagine, as if someone flipped a switch labeled bubble. It happened the way many fragile booms happen, through a chain of reasonable decisions that, repeated too many times, begin to produce something unreasonable. So we'll keep drifting backward, slowly. We'll return to the late 1980s, when Tokyo's nights were bright with a particular kind of certainty, and the future seemed not only prosperous, but inevitable. Before we rewind fully, it helps to name the feeling of the aftermath in a gentle, human way. After a crash, the world can become unusually quiet about ambition. Not because people stop working or stop caring or stop dreaming, but because the cost of being wrong suddenly feels sharper. A generation that has watched assets fall learns a new reflex: to treat optimism as something that must be proven again, and proven slowly. In Japan, that reflex would shape everything that followed. When banks are wounded, lending becomes cautious. When companies carry debt and uncertain asset values, they become protective of cash. When households sense that prices are not rising and wages are not racing ahead, they become patient. And patience in an economy can look like stillness. When people feel the future will be better, they borrow, invest, hire, build. When they feel the future is unclear, they wait. And waiting, multiplied across millions of decisions, can create a climate where the economy keeps functioning, yet struggles to accelerate. This is why deflation, or even the persistent expectation of low inflation, matters so much. If you believe things may be cheaper later, or at least not more expensive, there is less urgency. A purchase becomes something you can postpone. A project becomes something you can revise again. A raise becomes something a company hesitates to grant because it's not sure revenues will rise enough to support it. None of this requires despair. It can happen in a country that remains comfortable and orderly. It can happen in a society that is still highly educated, still inventive, still deeply capable. It is not triumph or failure, but endurance. Now, to trace the origins of the fall, we need to slip back into the late 1980s, when motion felt effortless. In those years, Japan had already achieved what many nations strive for: world-class manufacturing, rising living standards, and a powerful sense of collective competence. Money flowed through the system with an almost silken ease, and the nation's institutions, from banks to ministries to corporate groups, seemed to know how to keep everything balanced. And yet, in that very strength, a vulnerability was taking shape. Because when a system works well for a long time, it becomes easy to believe that it will always work well. People begin to trust the trend more than the underlying reality, and leverage, borrowing against those rising prices, begins to feel like a clever way to participate in something that is already guaranteed. So, in the next part of our walk, we'll step into the glow of the peak, and we'll watch how easy money, cultural confidence, and simple human imitation combine to lift prices far beyond what calm fundamentals could hold. But we'll do it gently, without blame, because bubbles are not usually built by villains. They are built by ordinary minds in extraordinary times. Now, we're moving backward into the late 1980s, and Tokyo looks different, not because the buildings changed, but because the meaning inside them did. Picture a city at night, lit from below by office towers, signage, and the steady shimmer of traffic. The streets have their own music, a soft chorus of footsteps, train chimes, distant announcements, and the hush of late hours. And beneath that surface, money is moving quickly, as if it has found a downhill slope. In many bubbles, the first ingredient is not greed. It is relief. Japan had faced pressures that made growth harder to sustain. A stronger currency made exports less effortless, and policymakers looked for ways to support domestic demand. Interest rates and credit conditions became more accommodating, and the financial system, confident, sophisticated, accustomed to stability, began to lend into a world that felt safe. Borrowing can be useful. It can build factories, housing, infrastructure, research, but borrowing also has a side effect. It can turn today's optimism into tomorrow's obligation. And if borrowing is based on assets whose prices are rising, those assets begin to play two roles at once. They are both the thing being bought and the thing being used as proof you can afford to buy more. This is where land enters the story. Japan is an island nation with dense cities and a deep cultural awareness of space. Land, especially in Tokyo and other major urban centers, carried not only economic value, but symbolic value. It was location and status, stability and inheritance, a kind of physical certainty in a world that changes. So when land prices rose, it was easy to tell a convincing story of scarcity, of demand, of permanence, of a country whose success meant that land would always be more precious tomorrow than it was today. And when that story becomes popular enough, it begins to shape behavior. Banks become more comfortable lending against property. Companies use real estate holdings as a kind of hidden strength. Investors treat land as a safe store of wealth, even as prices climb beyond what rents or wages can naturally support. At the same time, the stock market begins to glow with its own logic. Shares climb, and climbing shares attract more attention, and attention attracts more capital. The rising chart becomes a lullaby of its own, soothing away doubt with repetition. This is another quiet truth. Markets do not merely reflect beliefs, they create them. So, as the late 1980s progress, the boom starts to feel like the normal state of things. Promotions, bonuses, expansion plans, they all seem reasonable because the asset values on the balance sheet keep swelling like a tide that never retreats. And with each month that passes, caution becomes harder to justify because caution has an opportunity cost. If everyone else is gaining wealth on paper, standing still can feel like falling behind. At the top of a bubble, the most powerful force is not euphoria, it is certainty. Late 1989 carries that feeling. The air is crisp, the city is bright. The rhythm of work and commerce hums with practiced efficiency. And in the background, the market has been climbing so long that the climb feels like part of nature, like the way winter becomes spring. In that environment, risk disguises itself as tradition. A stock chart rising year after year can begin to feel like a record of competence. A balance sheet heavy with valuable land can begin to feel like permanent security. Borrowing, when rates are low and collateral is rising, can feel less like debt and more like a tool, a way to be rational in a world that is clearly rewarding participation. And so the final stage often arrives quietly. Prices become expensive by ordinary measures, but those measures begin to be waved away. People find new explanations. The future will be richer. The system is unique. The rules have changed. The country is different. Sometimes the explanations are even partly true. Japan did have extraordinary strengths, high savings, skilled labor, advanced manufacturing, social stability, a culture that valued precision and long-term thinking. These are real things, and real strengths can make an illusion last longer because they make it easier to believe. But even strong systems can become unbalanced when money is too easy and expectations become too smooth. Because a market can not only go up, it can go up for years. It can go up beyond reason. But at some point, something small shifts. A policy change, a tightening of credit, a subtle change in sentiment. And when the system is leveraged, when loans and collateral and portfolios are stacked like stones, a small shift can cause a large rearrangement. This is the gentle paradox. The stronger the agreement, the more surprising its end. When conditions tighten, even modestly, borrowers feel it first. The cost of holding assets increases. The ease of refinancing becomes less certain. Banks look at risk differently, and if banks begin to slow lending, the momentum that lifted asset prices begins to fade. Then the loop reverses. Falling prices reduce collateral. Reduced collateral constrains borrowing. Constrained borrowing reduces demand for assets. Reduced demand pushes prices lower. And what had felt like a stable staircase becomes something more like a slippery slope. The crash we began with in early 1990 is the visible part of that reversal. But underneath, the true story is a change in feedback loops, from reinforcing optimism to reinforcing caution. And so tonight, as we keep moving through this arc, we'll now return toward the fall again, but with clearer eyes. We'll watch how the long aftermath formed, how banks and companies learned to conserve, how households learned to wait, and how a nation faced with debt and an aging population began to carry the weight of history into the present. And now, with the summit behind us, we can drift forward again into those first falling days and see them with gentler precision. When prices begin to slip, the first emotion is often not fear. It is confusion. People look for the quick explanation, a temporary wobble, a rumor, a technical correction that will soon repair itself. In a long boom, the mind becomes trained to expect recovery. A dip is just a dip until it isn't. In the early 1990s, the decline in Japanese equities and property values began to change the smallest decisions. A lender asks for one more document. A manager delays a hiring plan. A buyer offers a little less than last month. These are quiet motions, polite, but they add up. And once the direction changes, it becomes harder to pretend that yesterday's prices were simply a baseline. Banks begin to feel the shift in a very practical way. Loans that seemed well secured by valuable land are now secured by land that is no longer rising. In good times, collateral feels like a soft pillow under risk. In bad times, it becomes a thin blanket. And then, slowly, it becomes a question. This is where the story turns from a market story into a balance sheet story, because markets can fall and rise again. But balance sheets carry memory. A debt taken on in 1988 still exists in 1992, even if the asset behind it has lost value. A loan extended with confidence still requires repayment, even if the borrower's cash flow has weakened. And when many borrowers strain at once, the strain moves back into the financial system itself. A crash, then, is not only the falling line on a chart, it is the moment when the future stops being used as collateral. And yet, on the street, life continues. People still commute. Children still walk to school. Restaurants still serve steaming bowls late into the night. The contrast is part of what makes this period feel almost dreamlike in retrospect. An outward normality paired with an inward tightening. If we could listen closely, we might hear it as a change in tempo. The economy still plays, but it plays slower, with longer pauses between notes. Investment decisions take longer. Mergers are reconsidered. Construction plans are revised. A whole society begins to prefer what is safe, even if it is small, over what is large, even if it might be rewarding. In some places, the repair did not happen cleanly. Losses were not always recognized quickly. A troubled borrower might be refinanced, extended, given time, because time felt kinder than admitting a mistake. It can feel understandable, even humane, but it also means the system carries weak spots longer, like a building holding scaffolding up for years, hoping it won't need to rebuild the wall. In the next part of our walk, we'll move from that first confusion into the long work that followed. The problem of bad loans, the cautious dance of repair, and the way a financial system can heal slowly in years measured not by headlines, but by patience. The problem with a slow repair is that it changes what an economy is willing to do. When banks are uncertain about the true quality of their loan books, they become careful in ways that don't always show up as a single dramatic event. They lend, but with narrower terms. They roll over, but with tighter conditions. They prefer the familiar borrower over the new idea. And for a business, that difference can mean the difference between expanding and simply maintaining. In the years after Japan's bubble burst, bad loans accumulated like silt in a riverbed. Some loans were tied to property whose value had fallen. Others were tied to businesses that had grown under assumptions that no longer held. And as those assumptions weakened, the clean, brisk circulation of credit slowed. Credit, in a modern economy, is a kind of oxygen. You can live without a sprint, but not without breath. When credit becomes scarce or cautious, the whole system learns a new posture. Conserve, postpone, protect. For companies, this often shows up as a preference for paying down debt, building cash, and avoiding risk. Even profitable companies can become defensive if the surrounding climate feels uncertain. For banks, it can become a long, careful process of provisioning, restructuring, and gradually strengthening capital. For households, it can show up as higher savings, and restrained spending, not because life is terrible, but because the future feels harder to price. And then, gently, another pattern begins to form. Prices stop rising. In many countries, people treat inflation as an annoyance. But a little inflation can also be a kind of motion. It encourages spending today. It makes nominal revenues grow. It helps debts feel lighter over time because incomes and prices gradually rise while the principal stays the same. When inflation fades or turns into mild deflation, the psychology flips. If things will be the same price later or slightly cheaper, urgency softens. Later becomes comfortable, and comfortable later can quietly become a habit. This is not a moral failing, it is a reasonable adaptation. A society that has watched a bubble collapse becomes sensitive to overpaying. It becomes skilled at waiting. It becomes disciplined in a way that is admirable. And yet, in aggregate, it can reduce the energy of demand. So the story of Japan in the 1990s becomes not a story of chaos, but a story of persistence under a slower rhythm. Repair without rupture. Stability without acceleration. An economy that is still capable, still inventive, still deeply organized, and yet somehow unable to regain the easy momentum of the previous decade. In the next part, we'll sit with that quieter force, deflationary pressure, and how it shapes wages, spending, and the long, patient choices of a nation. When a nation enters a long period of weak prices and cautious spending, policymakers begin to reach for tools that can feel both powerful and strangely subtle. In Japan, interest rates moved lower over time, not as a single dramatic act, but as a gradual attempt to make borrowing easier and to encourage investment. The idea is simple enough to hold in the mind like a smooth pebble. If money is cheaper to borrow, more projects can make sense. More homes can be bought. More businesses can expand. Motion can return. But when confidence has been bruised, cheap money does not always create bold choices. Sometimes it simply makes waiting more comfortable. A company can refinance, then postpone expansion anyway. A household can save at lower returns, but keep saving because safety matters more than yield. The economy keeps breathing, yet it does not sprint. So policy becomes persistent. Support is applied not once, but again and again across years. The central bank experiments. The government spends to cushion downturns and keep demand from falling too far. New programs arrive, and then more programs arrive, each intended to nudge the system back toward a healthier rhythm. Here, it helps to remember that debt for a country is different than debt for a household. A government can roll its obligations for a long time, especially when its citizens save and its institutions are trusted. Debt can act as a stabilizer, a way to smooth the bumps of recession and protect the social fabric. And Japan did protect its fabric. The trains kept running, cities remained safe, infrastructure remained cared for. Life retained a dependable grace. Yet over time, the cumulative borrowing became immense, and the choices became more constrained. When the public debt stock grows very large, a greater share of the national conversation becomes about managing what already exists, servicing, refinancing, maintaining, rather than taking bold new steps. It is not that boldness disappears. It is that boldness has to compete with stewardship. In the background, another long force continues to work quietly. Time itself. A society can endure slow growth for a while if it expects a future rebound. But if the future begins to look smaller, if there will be fewer workers, fewer young families, fewer new households, then the baseline expectation shifts. The economy's normal speed begins to feel slower, not because people have given up, but because the underlying population engine has changed. And through all of this, the yen remains a quiet reference point, watched by global investors, because Japan's rates help set the tone for borrowing and investing far beyond its shores. So in the next part, we'll step away from policy tools and look at the softer demographic undertow, aging, low birth rates, and what it means for an economy to become, year by year, a little older, a little smaller, and still remarkably steady. Demographics are not loud. They do not ring bells or flash across screens. They arrive the way an evening arrives, gradually, until one day you notice the light is different. Japan's population began to age, and the pace of new births stayed low. Over time, the working age share of the country shrank, and the share of retirees grew. That shift changes the economy in ways that are practical and intimate. Fewer young adults means fewer first apartments, fewer new households furnishing rooms, fewer families buying cars, fewer children filling classrooms. An older society can still be vibrant and productive, but its spending patterns change. It tends to spend more on health and care, more on comfort and maintenance, and less on the rapid expansion that comes with youth. It also changes the labor market. When there are fewer workers, companies have to compete for talent, automate, or reorganize. This can raise productivity in some areas, but it can also limit the sheer volume of output the economy can produce. Even with strong technology, fewer hands and fewer hours set a gentle ceiling on growth. And demographics also shapes psychology. If a nation expects its population to decline, it naturally becomes more careful about long-term investments that depend on a larger future customer base. Building a new suburb, a new chain of stores, a new factory, these projects feel different when the future is expected to be smaller. The mind leans toward preservation. Make what we have last. Make it work better. Make it safer. This is where Japan's story becomes especially subtle. Many of the qualities that make the country feel so soothing, its order, its reliability, its attention to detail, also make it skilled at maintaining. And maintenance is a kind of quiet victory. But maintenance alone rarely creates fast growth. So the lost decades are not only about a financial crash, they are about an economy adapting to a new reality. Less population momentum, large accumulated debt, and a collective preference for stability after an era of painful imbalance. And yet, the story does not end in stillness. Japan remains one of the world's great pools of savings, and its financial institutions remain deeply connected to global markets. When domestic yields are very low, investors naturally look outward. Capital flows across oceans into foreign bonds, foreign credit, foreign equities, quietly, steadily, like a river finding its path. That outward flow becomes part of the modern world's plumbing, and it sets the stage for why today small changes in Japanese interest rates and currency expectations can create ripples far beyond Tokyo. In the next part, we'll return to the present day, where policy begins to shift and where an old global habit, the carry trade, can unwind when the wind changes. Now we come back to the room we're in today, and we can feel how the past still lives inside the present. For years, Japan was known for extremely low interest rates. In a world where other countries offered higher yields, Japan became, in a quiet way, a source of cheap funding. If you can borrow in a currency with low rates and invest in assets elsewhere with higher returns, the difference can look like a gentle stream of income. This is the simple heart of what people call the carry trade. It sounds almost harmless when described slowly. Borrow low, invest higher, hedge when you can, keep it steady. But the carry trade depends on calm weather. It depends on stable exchange rates and predictable conditions. If the funding currency strengthens or if volatility rises, the trade can flip from comfortable to stressful. The same positions that were easy to hold can become urgent to reduce, and that's when the river can run backward. A strengthening yen can squeeze borrowers who must repay in yen. Rising Japanese yields can make domestic assets more attractive, drawing money back home. And if many investors try to unwind similar trades at the same time, the selling pressure can spill into other markets, stocks, bonds, credit, especially in places that had benefited from that steady outward flow. Sometimes the ripple looks like a sudden rush into safe assets, or a quick widening of spreads, or a brief moment where liquidity feels thinner than it did the day before. In recent times, Japan has taken careful steps toward policy normalization, signaling a world where rates may not be pinned near zero forever. The change is not only in the number itself, it is in the meaning. It suggests that the long era of one-way expectations, always low, always easing, may be shifting toward something more balanced. Markets, as you know, are sensitive to shifts in meaning. They adjust not only to what has happened, but to what they believe might happen next. And so, even small signals from Japan can echo widely, because Japan sits at the center of so many quiet, leveraged habits built over decades. Still, it's important to keep the scale gentle. Unwinds do not always become crises. Often, they are simply reorganizations of risk, a tightening here, a repricing there, a little less confidence in one trade, a little more demand for caution in another. Tonight, we won't chase headlines. We'll hold the deeper lesson. The past can make a country appear still, while its influence remains active beneath the surface. Japan's bubble and its long aftermath shaped global finance in visible and invisible ways. And the next chapter, normalization, demographics, and shifting capital flows, will do the same. In the next section, we'll begin to connect these ripples back to the original rise and ask what the world learned and what it forgot as the lights in Tokyo continue to glow. Sometimes, after we've traced a long arc of prices and policies, it helps to return to something small and physical. A cup of tea cooling on a desk, a commuter train gliding into a station, a stack of papers tied with a neat band. These are the kinds of details that persist through booms and busts, reminders that the real world does not move at the speed of a ticker. And yet, finance does leave footprints. One of the quiet lessons of Japan's bubble is that when an asset boom ends, the damage is often less about the day of the fall and more about what happens afterward. The long period when balance sheets are repaired and confidence is rebuilt inch by inch. In the years after the crash, many Japanese companies became unusually focused on resilience. They reduced leverage. They accumulated cash. They avoided risky expansion. From one angle, this looks like caution. From another, it looks like adaptation, learning to survive in a world where the old assumptions no longer hold. There is a gentle trade-off here. Cash on a balance sheet can protect you from shocks, but it can also mean fewer investments, fewer experiments, fewer leaps into the unknown. When many companies choose protection at once, the economy becomes safer and slower. This is part of why Japan's experience became a reference point for the rest of the world. Investors, economists, and policymakers watched and wondered, could other countries fall into a similar pattern? A burst bubble, a wounded banking system, weak inflation, and years of slow motion. In different crises, different places would borrow Japan's vocabulary. Balance sheet, recession. Liquidity trap, lost decade. These phrases are not spells, but they point to something simple. When debt is high and optimism is low, the future can feel expensive. And because Japan remained stable and functional through it all, the world learned another lesson too. Stagnation is not always dramatic. It can look like calm streets and clean stations paired with an economy that struggles to regain its earlier pace. So tonight, as we keep moving forward, we can hold Japan not as a warning carved in stone, but as a quiet teacher. The story is not that prosperity is fragile. It is that prosperity needs room to breathe, and debt can narrow that room if it grows too heavy. In the next part, we'll look at how Japan tried repeatedly to widen that room again, through reforms, through stimulus, through patient experimentation, and through a long attempt to change the national mood from waiting back into moving. Picture the exchange building not as a stage, but as routine, doors opening, footsteps, quiet paperwork. The surface stays orderly, which can hide how deeply decisions are being rewritten underneath. That is what we're listening for tonight. If the 1990s were a decade of repair, the years that followed became an era of experiments, some bold, some cautious, many persistent. Policies arrived like careful hands adjusting a dimmer switch rather than flipping a light on. Interest rates were held low for long stretches. New forms of monetary support were introduced. Governments used spending to cushion downturns, to keep demand from sinking too far, to preserve employment and stability. And because the public debt grew over time, the country also became something else, a place where the interest rate itself carried enormous weight. When rates are low, the cost of servicing a large debt stock stays manageable. When rates rise, even a little, the arithmetic can change. This is one reason Japan's central bank moved carefully, like someone stepping across a polished floor in socks. Policy had to support growth and fight deflation while also respecting the delicate ecosystem built around very low yields. Meanwhile, inside companies, a different kind of change began to take shape. Corporate Japan slowly shifted, sometimes under external pressure, sometimes under internal realization, toward greater attention to profitability, governance, and shareholder returns. It was not a sudden conversion, it was a gradual tilt. You can think of it like a garden being pruned after years of unchecked growth. Excess is trimmed, cash piles are questioned, capital is asked to earn its place. The goal is not spectacle. The goal is healthier growth, even if it arrives quietly. And then, in the 2010s, another wave of effort arrived, framed not as a single policy, but as a coordinated attempt to change direction. Monetary easing, fiscal support, and structural reforms were described as arrows aimed at the same target, reviving growth and, perhaps more importantly, reviving expectations. Because expectations are contagious. If businesses believe prices and wages will rise gently, they behave differently. If households believe the future will be a little brighter, they spend differently. If investors believe the economy has turned a corner, they allocate capital with a different posture. Japan spent many years trying to shift that posture, to move the national reflex from caution toward measured confidence. Some progress appeared in pockets. Strong global companies, advanced manufacturing, services evolving, tourism, technology, and later, signs of firmer wage dynamics. Not a miracle, not a sprint, but movement. And so, as we approach the recent present, we can sense a subtle change. The idea that the long era of always low, always easing might not be permanent. That possibility is enough sometimes to reshape global flows. In the next part, we'll zoom in on those flows, how Japan's low rates became a foundation for borrowing and investing worldwide, and why even small shifts can send ripples through distant markets. To understand Japan's modern influence, it helps to picture global finance as a system of quiet pipes. Money moves through them every day, pension funds, insurers, banks, asset managers, seeking safety, yield, liquidity, or some careful blend of all three. Most of the time, this movement is calm. It is simply allocation, a choice among possibilities. But when one large part of the system has unusually low interest rates for a long time, it becomes a kind of reservoir, a place where funding feels cheap, predictable, and plentiful. Japan, for many years, served as one of those reservoirs. When yields at home are very low, investors look outward. They buy foreign government bonds, they buy corporate credit, they buy global equities, they finance loans and investments across borders. Sometimes they hedge currency risk, sometimes they accept it. But the overall effect is similar. Capital flows from Japan into the wider world. And because these flows can be large and persistent, other markets begin to absorb them as if they were part of the natural landscape. Yields elsewhere can be a little lower than they otherwise would be. Risk assets can feel a little better supported. The world becomes used to Japan as a steady source of demand for overseas returns. This is where the carry trade becomes a useful metaphor again. Borrowing in a low-rate currency and investing in higher-yielding assets can be profitable, but it can also be fragile. The trade is comfortable when the funding currency stays stable or weak. It becomes uncomfortable when that currency strengthens, because repayment grows more expensive in local terms. The unwind, when it comes, is rarely announced. It can begin with a subtle shift in expectations, a signal that rates may rise, a hint that policy is changing, a move in the currency that makes risk managers sit up straighter, and then, as positions are reduced, the act of unwinding itself can amplify the move. Selling pushes prices, prices trigger more selling, and suddenly what was slow becomes quick. This is how distant markets can feel Japan's weather. A stronger yen can tighten conditions for leveraged investors. Rising Japanese yields can draw money back toward domestic assets. Volatility can spike as trades are reduced, and in a world where many portfolios are connected through similar assumptions, a change in one corner can briefly touch many others. Still, it's worth saying softly, these are ripples, not necessarily waves. Global markets can absorb a lot, but the lesson is about sensitivity. When a country has sat at the center of global funding dynamics for decades, even a careful policy shift can matter. In the next part, we'll return to the human scale again. What it feels like for a society to carry a large debt and an aging population, and how a nation can remain calm while its financial influence continues to travel far. If you listen closely to Japan's story, you can hear two kinds of time moving at once. There is fast time, the time of markets, prices, headlines, trading days, and there is slow time, the time of demographics, institutions, and cultural habits that change over generations. Japan's long stagnation sits at the meeting point of these two clocks. A large public debt can be sustained for a long time when the society is cohesive, savings are high, and institutions are trusted. In Japan's case, domestic ownership of government bonds has long helped maintain stability. Debt became a kind of national blanket, warm, protective, heavy. But a blanket, after enough years, can also feel like weight. An aging society needs more health care, more long-term care, more pensions. These are natural needs, not problems to be scolded. They are signs of longer lives, of successful public health and safety, yet they do shape budgets. They shape tax choices. They shape the balance between investing in the future and caring for the present. At the same time, fewer young workers means the economy has less automatic expansion. Growth becomes something you must earn through productivity, innovation, and participation, not something delivered by a rising population. Again, this can be done. Japan is skilled at efficiency, automation, and quality. But the baseline is different, and this is why policy changes can feel so delicate. When the economy's natural speed is slower, sudden tightening can risk choking off what momentum exists. When debt is large, rising rates can complicate the math. When society values stability, abrupt change can feel unwelcome. So, Japan's path has often been one of gradualism, small steps, careful messaging, adjustments made with attention to social and financial stability. From the outside, this can look like indecision. From within, it can look like responsibility. And today, there are also signals of change that would have seemed unlikely during the deepest deflationary years. Occasional periods of firmer inflation, wage negotiations with more energy, corporate shifts toward better capital use, and a world in which Japan is not only an exporter of goods and savings, but also a magnet for renewed investor interest. The story remains complicated, but not hopeless. It is a story of constraints and adaptation, of a society learning to live well within slower growth and still looking for ways to gently improve its trajectory. There is, in that gradualism, a kind of quiet engineering. Adjust, reinforce, test, and adjust again. We'll keep that rhythm as we go. There is a particular humility that comes from watching a boom turn into a long pause. Japan's bubble years were dazzling, but what followed was not ruin. It was a lesson in endurance, a reminder that economies can continue to function and societies can continue to thrive in many ways, even when the financial engine runs at a lower speed. And yet, the lost decades also reveal something tender about markets. They are made of stories. During the rise, the story was that prices reflected a new permanent strength. That land was destiny, that the future had already been earned. During the fall, the story changed to caution, to repair, to careful saving. The stories were not entirely wrong. They were simply too smooth, too confident in one direction at a time. This is why bubbles are so instructive. They show what happens when a narrative becomes absolute. The Japanese experience also shows how debt can both stabilize and constrain. Borrowing helped soften downturns and preserve social stability. It supported a long period of careful adjustment, but the accumulation of debt also narrowed future choices, making policy more sensitive to interest rates and making the path of normalization more delicate. And then there is the slow clock of demographics, reminding us that growth is not only an output of policy, it is also a reflection of population, age structure, and the quiet habits of households. When societies age, they often become more risk-aware. They spend differently, they invest differently. The economy becomes less about expansion and more about stewardship. And yet, because the world is connected, Japan's choices do not stay within Japan. When Japan's rates were extremely low, global investors built habits around that fact. When that fact begins to change, the habits adjust. The carry trade unwinds in pockets, then reforms in new shapes, then unwinds again. Risk moves, sometimes quickly, across borders. The world is reminded that financial plumbing, though mostly hidden, can carry sudden pressure. So, perhaps the gentlest takeaway is this. In markets, nothing is permanent, and in societies, nothing is only financial. A nation can be brilliant and still experience a bubble. A society can be stable and still stagnate. And a small shift in one corner of the global system can ripple outward, not because anyone intended it, but because the connections are real. In the next stretch of our story, we'll begin to soften toward closing. We'll revisit the present one more time. Notice what feels different now, and let the lesson settle into something quieter than analysis. Something like a calm understanding you can carry into sleep. Let your shoulders sink as you hear that. We're not here to forecast, only to understand, and gentle understanding can be restful. In a moment, we'll return to the present and then let the story soften. Now, as we return once more to the present, we can do it the SleepWise way. Not with urgency, but with soft attention. In recent years, the world has felt less predictable. Inflation appeared in places where it had been quiet for a long time. Interest rates rose in places where they had been held low, almost like a promise. Supply chains, energy prices, geopolitics, technology, all of it reminding us that stability is not a permanent state, but a garden that needs tending. Japan moved through this change in weather with its familiar patience. For decades, many investors treated Japan as the land of near-zero rates, a dependable anchor in a world that kept shifting. And then, gradually, the anchor began to lift, just a little, signaling that the long era of one-way expectations might not last forever. What changes first is not always the economy. It is the assumption. If you assume borrowing will stay cheap, you build strategies around it. You finance projects with confidence. You reach outward for yield. You accept thinner cushions because the ground feels steady underfoot. But if you begin to suspect that funding costs could rise or that a currency might strengthen, the same strategy starts to feel less restful. Not because it is suddenly wrong, but because it is suddenly exposed to more weather. That is why small policy steps can matter. Markets are not only made of numbers, they are made of stories about the future. And when the story shifts, even subtly, positions begin to change. Risk managers become more alert. Portfolios are rebalanced. Old habits are reviewed. At the same time, Japan's domestic reality remains what it has been for years: a society growing older, a public balance sheet carrying a great weight, and an economy that values steadiness. That steadiness is not weakness. It is a kind of discipline, but it also means changes come in measured steps, and each step is watched by citizens, by institutions, and by the rest of the world. So tonight, we hold the present as continuation, not as drama. Japan is not returning like a hero in a loud story. It is simply adjusting slowly to the world as it is. In the next part, we'll look gently at the carry trade again, not as a technical trick, but as a simple habit. And we'll notice how habits unwind, not with explosions, but with quiet pressure, like a hand slowly loosening its grip. Picture a financial decision as something almost domestic. A folder opened, a pen paused, a line item read twice. When the world feels stable, the pen moves quickly. When the world feels uncertain, the pause grows longer. Japan's story is full of these pauses, careful, deliberate, often wise. And because Japan has been such a quiet reference point for global funding, the pause is shared. A shift in Tokyo can be felt in New York, London, Singapore, as a faint change in the background hum. That is the kind of influence we are listening for tonight. Softly, without fear. Think of the carry trade as a bedtime story told by numbers, simple enough to understand without waking the mind. A low-rate currency is like a calm starting point. If borrowing is cheap, you can take that borrowed money and place it somewhere that offers a little more. Another country's bonds, another market's credit, another set of assets that seems steadier or more rewarding. If everything remains calm, the difference between the low borrowing cost and the higher return becomes a gentle stream. But streams depend on the slope, and the slope can change. If the funding currency strengthens, repaying the borrowed amount can feel heavier. If interest rates rise in the funding country, borrowing becomes less cheap. If volatility increases, the whole strategy becomes less restful, because even a small adverse move can suddenly matter to a leveraged position. When that happens, investors begin to reduce exposure. They sell what they bought, they repay what they borrowed, and they try to return to safety. If many investors are positioned similarly, those actions can echo. Selling can cause prices to fall. Falling prices can trigger more selling. A quiet movement becomes a faster one, not because anyone wants drama, but because risk systems and margin rules do what they are designed to do: reduce exposure when uncertainty rises. This is what people mean when they talk about an unwind. It can show up as a stronger yen, because people need yen to pay back yen loans. It can show up as weakness in the assets that had been popular destinations for borrowed money. It can show up as yields moving, spreads widening, liquidity thinning, all for a brief while. And then often, things stabilize again. The world adapts. Trades are resized. Portfolios are rebalanced. The system, after a short shiver, finds its footing. For our sleepy understanding, the point is not the day-to-day noise. It is the principle. When a very large part of global finance has grown used to Japan as a source of cheap funding, even careful shifts in Japan's policy can change the global rhythm. Japan's role is a little like the moon's role in the tides. The moon does not crash into the ocean. It simply exerts a steady influence, and when conditions change, the water moves. So, if the carry trade unwinds here and there, it is not automatically a signal of catastrophe. It is often a reminder that markets are connected through shared assumptions, and assumptions can turn into crowded habits. And crowded habits can move quickly when the wind changes. In the next part, we'll step back and look at the full arc again, from bubble to crash to long aftermath. And we'll gather a few gentle lessons that can settle the mind rather than stimulate it. And you don't have to picture it as a stampede. Often, it's like a theater emptying after a show. Slowly, then all at once. The movement feels bigger because so many people chose the same door. When we look at the whole story from a distance, it becomes less like a warning siren and more like a landscape you can walk through calmly. The rise in the 1980s shows what can happen when strength meets easy money. Japan's excellence was real. Its engineering, its manufacturing, its social cohesion, its deep pool of savings. But when credit becomes abundant and asset prices begin to feel like proof, belief can outrun reality. Land becomes myth. Stocks become destiny. Leverage becomes normal. The fall shows the tenderness of that belief. A bubble doesn't only inflate prices, it inflates expectations. It teaches people to rely on a certain future. And when the future changes, the adjustment can take years because debts linger, institutions heal slowly, and memories shape behavior long after headlines fade. The long aftermath shows something even quieter. Stagnation can be stable. It can occur without chaos. It can coexist with safety, beauty, and daily competence. An economy can deliver a high quality of life while still struggling to generate faster growth. That is not a contradiction. It is simply a different rhythm. Debt and demographics become the slow frame around the picture. A very large public debt stock can cushion downturns and preserve stability, but it also makes policy more sensitive. An aging population can bring wisdom and care, but it can also reduce the natural pace of expansion. These forces do not announce themselves in a single year. They shape decades gently, like erosion shaping stone. And then the modern chapter reminds us that global finance is built on habits. When one country's interest rate has been near the floor for a very long time, the world learns to borrow from it, invest around it, and assume it will remain unchanged. When that assumption shifts, the world adjusts, sometimes smoothly, sometimes with brief turbulence. So, what are the lessons we can keep tonight? First, certainty is seductive. It can make us forget that markets are not laws of nature, but human agreements. Second, repair is slow. It requires patience, time, and a willingness to accept a new pace. Third, the world is connected in ways that are both practical and almost poetic. Money moving like water, pressure traveling through hidden channels. Held softly, these lessons don't make the mind anxious. They can make the mind steadier, because steadiness comes from seeing how things truly work and then letting that understanding rest. In the next part, we'll step away from mechanisms and return to atmosphere. Tokyo at night, the gentle hum of the city, and we'll begin to dim the lights towards sleep. And perhaps one more. A society can learn to value resilience so strongly that it becomes cautious with its own potential. That caution can be wise, and it can also be costly. The balance is delicate, and Japan has been living inside that balance for a long time. So let's return one last time to Tokyo at night. The city is not a metaphor. It is a living place. Trains gliding, sidewalks shining faintly, apartment windows lit like small rectangles of warmth. Somewhere, someone is finishing a late shift. Somewhere, someone is rinsing a cup. Somewhere, a television murmurs softly before it clicks off. In a story about markets, it's easy to imagine everything is governed by excitement or fear. But the truth is quieter. Most people live inside routines. They cook, they commute, they care for family, they take small steps into tomorrow. And the economy, for all its abstractions, is made of these ordinary motions. Japan's bubble years were bright, but brightness is not always comfort. Sometimes brightness keeps you awake. It fills the mind with urgency, with comparison, with the feeling that you must act quickly or be left behind. A rising market can feel like a bright room where it's difficult to rest. The years after the crash, though difficult in many ways, produced something different. A collective learning about caution, about resilience, about the long view. Not everything about that learning was desirable. Too much caution can become its own trap. But some of it was deeply human, an understanding that life continues even when numbers change, and that patience is not the same as giving up. If you take nothing else from tonight, take this. The world can change without breaking. Markets can fall and still be rebuilt. Nations can slow down and still be admirable. And even large forces like debt and demographics are not judgments. They are conditions that shape choices. We don't need to forecast what will happen next. We don't need to solve anything in the dark. We only needed to understand gently how a rise can become a fall, and how a fall can become a long, steady path forward. Now, let the skyline blur. Let the market lines fade into the sky. Let the yen symbols, the ripples, the policies, the decades become distant, like streetlights seen through rain. In the next and final part, we'll let the last ideas drift away like mist. We'll leave the city where it is, and we'll rest. You might imagine the old exchange floor in the daytime, orderly, almost ceremonial. And then imagine it at night, quiet, the chairs pushed in, the screens dark. The market has always been made of moments like that. Activity followed by stillness, risk followed by rest. Outside, the city's sounds soften, a distant announcement, the whisper of tires on wet road, the small metallic click of a bicycle stand. Even the air seems to slow, as if Tokyo itself is breathing more deeply. And somewhere far away, traders and investors adjust their positions, not because they are chasing Japan, but because they are connected to it. A few basis points here, a move in the yen there, and the global system shifts its weight, the way a sleeper shifts under a blanket, briefly, then settles again. Tonight we began with the crash. We stood in the quiet after the peak, when the city looked unchanged but the mood had shifted, and the numbers on the page began to carry a different weight. We walked backward into the warmth of the boom, into easy credit and shared confidence, into land treated like certainty and charts treated like lullabies. Then we returned to the long aftermath, banks repairing, companies conserving, households learning to wait. We felt how weak prices can change behavior, how patience can become habit, and how habits can shape decades. We noticed the slow clocks, too. Debt, accumulating like layers of careful protection. Demographics, arriving like dusk, gradually changing the color of the future. And we came back to the present, where Japan's careful steps toward normalization can matter far beyond its borders, because global finance has built so many quiet routines around Japan's low rates. All of this can sound heavy in daylight, but in the dark it becomes something softer, a reminder that systems are made of people and people can adapt. A reminder that certainty is never permanent, and that's not a tragedy. It's simply the nature of living in time. A reminder that when the world feels complicated, the most restful thing is not to force control, but to find understanding and then let understanding become calm. So now, let the charts fade. Let the skyline dissolve into haze. Let the yen symbols, the ripples, the policies, the decades become distant, like streetlights seen through rain. Your work is done for tonight. If thoughts of money and markets begin to tug at you, remember, most of what moves a market is the same thing that moves a human heart: hope, fear, imitation, and the wish to feel safe. When we see that, the noise becomes less personal. It becomes a pattern, like waves, and waves always settle. Somewhere beneath the headlines, ordinary life continues. A last train home, a kettle warming, a window going dark. These quiet acts are the real economy, steady and human, carrying on through every cycle. So you don't need to forecast. You don't need to solve debt, demographics, or the next ripple in global finance. Tonight is only for gentle understanding, and understanding is enough. Let your shoulders sink and let the story drift to the edge of your awareness, like distant lights softened by rain. If the mind reaches for one more thought, you can let it pass like a train you don't need to catch. Another will come. For now, you can stay right here in the quiet. Breathe in slowly and let the breath out even more slowly. Feel the bed beneath you, the quiet around you, the sense that nothing is required of you in this moment. The world continues its patient motion, and you are allowed to rest within it. Good night.